Take a look at Bitcoin, up about 2.5% today to about 39,300. But that downtrend's been in place here for a while, despite the fact that there have been reasons to go into safer haven trades.
In times of like heightened political uncertainty and geopolitical uncertainty, people are looking for ways to reduce their risks associated with centralized governments, and crypto assets offer them that exact opportunity.
I think that has fundamentally changed at all these organizations because the fund sizes have gone up and the mathematical reality of venture capital has changed. It took somewhere between 3 to 5 years for most stocks to bottom. And they bottomed, I think, peak to trough somewhere, 90. Towards 80% of where they were in 2000, right? So it took 3 to 5 years to go basically minus 80%. We did that in 3 months, maybe 4 months. And efficient. So the markets have become a lot more efficient over time. So now that we have that reset, it's pretty natural that there's going to be a very quick reset on the private market side. And, you have to go where the bodies are buried. And what I mean by that in this case is the overwhelming misvaluation of late stage private companies. And so these folks don't have much of a choice. They have a lot of money that they've raised before all of this happened. They have a huge portfolio of stuff that they've marked up or have been marked up by others. And they don't want to go through the pain now of resetting. So part of the easy strategic decision there is to say, you know what, we know this is a little bit radioactive, but instead of really figuring out what the mark on these companies are, we'll go to a different sort of part of the playground and play there because we don't have to go and deal with these issues. And, we can do 10, 15, $20 million checks into early stage businesses. Pretty normal reaction strategically. But I think the reality is that at some point in the next year or two, these other companies have to get public. The hope is that the market catches back up so that you can defend the last valuation. And that's the way that this stuff doesn't require a lot of pain. The problem is if you're high burn and you were counting on yet another successive round, or you're at a point in your life cycle where you need to go public, in the next 2 years, if you go public, you will get taken to the woodshed. You can't conflate having an enemy with having a different view. 100%. Those aren't the same thing. Having an enemy is a serious deal, right? Whether that's domestic or international. That's what we had to do in World War I, World War II, and the FLQ crisis. This is just somebody who has a different opinion. I don't agree in mask mandates is what one person says. I want a mask mandate is what the other person says. The idea that you can deplatform one or the other, or fire them from their job, or prevent them from having access to the money that they've earned, or preventing other people from donating money, that's really, it's a really low bar. And I think when you normalize this kind of behavior, it's a very slippery slope. And so if somebody else were to do it, they now have, like it's, again, going back to the René Girard sort of philosophical discussion from last week, one of the things about these stoning rituals, right, that Sachs talked about, that we talked about last week. One of the things that René Girard talks about is it is always hardest for that first person, right? The first person that throws the stone, right? That's how Jesus was able to diffuse that incident as described in the book of John. But in a different example, the first person that throws a stone all of a sudden normalizes it for everybody else after them. And then these stonings become commonplace or became commonplace. So similarly, it's like if you're a sitting Democratic person who just decides this doesn't work for you, you can't flip the script and basically remove everybody's democratic rights. That's really crazy. The minute you say something that Xi Jinping doesn't like, it's a stroke of a keyboard key. It's a database entry, and you just basically reroute who belongs. If you had said in isolation 2 or 3 years ago, would any of these things ever happen? We all would have just looked at each other and said, it's impossible that these things could happen. But the problem is, fast forward 2 years of a pandemic, I think we have let a lot of our civil liberties decay right under our nose, and we're not willing to fight for it because it's become too tribal and rights have been politicized. So the idea of having rights all of a sudden has to be a decision between whether you're left or right. The two most valuable pieces of private equity that I own is a company called DCG, and it's a company called Netscope. And collectively, it's like $1 billion worth of stock that I own.
What?
I'm on the board of one. I'm not on the board of the other anymore. And I text with these guys maybe once every 2 or 3 months at best. So, completely confirming, David, your point that great founders are just N of one individuals, But that's very different than the Series A playbook. Because when I ran institutional money, I'm telling you, there is a pressure to be involved and show some value. And I do think that there is a level of judgment on the CEO that has happened. Now, maybe that's changed historically, but I think that's the single biggest pivot that one would exploit if you were Tiger or Coatue or D1 stepping into the early stage game, which is to essentially make it a feature. And it's not dissimilar to when DST and Yuri Milner entered the late stage round. What was his big differentiation? I'll take common stock and I won't take a board seat. Common and preferred converged in price per share. So buying common in a late stage company was the same as buying preferred. So when you set up a company, you have a price per share of the common stock and then a price per share that the Series A investor has. The Series A investor is buying preferred shares that actually looks more like debt than equity. And what I mean by that is there's typically a coupon, there's a rate of return, there's accumulated dividends. All these features give it a certain price per share. And that gap is typically around 20 to 1 when you set up a company, okay? And that's what allows you to hire employees and give them very, very cheap options with embedded upside. Then what happens is you raise more and more of these Series B, Series C, Series D, these preference stack, right? Preferred shares build up. But the value of the common keeps rising too. And by the time you go public, the gap converges. I realized in this discussion that the market has really meaningfully changed, meaning when I was actively investing, even in the early 2000s, in the 2011, 12, 13, there was a culture where if you underperformed, you would get replaced. I guess is true has really changed, which is if you're running a multi-billion dollar fund where every check is $20 million, the upside is billions, but the downside is negative 20, there's just no point. I think it was known as a very tough, demanding place. I think Benchmark was known as a very tough, demanding place because the money was much more finite. There's a difference between high expectations, which I think all these folks have to have, and the willingness to replace the founder as CEO. And what I'm saying is every VC claims this, but there were a handful of VCs that had the courage to do this. I mean, famously, Mike Moritz and John Doerr, had it out with Larry at the, right after this round, like either go public, get your business model in order, or give us our money back, famously at Google. So they're willing to draw a line in the sand. I think that has fundamentally changed at all these organizations because the fund sizes have gone up and the mathematical reality of venture capital has changed.